All righty, welcome to week 8, our final week. This week is not only a busy week, but it's a short week. So if you're going into the course content this week, we have to read chapter 16, have your presentations and the videos. And then under the assignments, not only do we have the discussion board, your Learn Smart, and your homework, all of this plus your final exam is going to be due on Friday this week, not Sunday. So it's a short week and we have a lot to pack in here. So good luck to everybody. And I know this is going to be a hectic week for y'all. So reach out and let me know however I can help y'all if you need. This week's discussion board is relating to cash flow and the cash flow statements, determining the difference between the direct method and the indirect method. So talking about the statement of cash flows, and I know this is a little bit busy. I tried to color code some things as we go through it. So on the statement of cash flows, as we've discussed, cash is king. And although we do recommend the accrual method of accounting, within that financial packet, we're still going to present the statement of cash flows because everybody's going to be interested in what are we doing with our cash. And you can tell a lot about a company by looking at whether or not their cash is coming from their day-to-day operating activities, what they're doing with their investing, and then how are they financing that. So no matter if you're going to do the direct or indirect method, within the statement of cash flows, there's 3 distinct listings, the categories. It's your day-to-day, is your operating. Then what are you doing? Hopefully your operating is going to be in a positive. Companies that are just starting out, you might see some negative operating as they try to increase their sales and get to scale. But what we're looking for is hopefully a positive operating activity. Then we want to be seeing that the company is investing in itself. Okay, now if it's a more established company, then the investing is going to be pretty routine, either updating fixed assets here or there. The longer a company's been around, the less likely they are going to continue to make future investments. But if they're just starting out, we should see a lot of investing. And this is going to be any assets that we're purchasing. So we're starting new warehouses, we're creating new manufacturing lines, we're putting into our R&D, whatever this long-term asset is our investing. So this is what the company is doing with the funds. And then financing is how are they getting those funds? So is it by increasing debt, increasing equity? Maybe if they're further along the lines and we're actually returning, making payments on the debt, making payments back to shareholders. So this is going to be your third party. How are we getting those funds? So it's going to be easy to confuse investing and financing because up until this point you thought, hey, maybe there might be the same. But investing is what are we doing with the means, and financing is how do we get that cash. Okay, so if you remember, we started this semester out by saying assets equals liabilities plus equity, and I told you we wouldn't get much more complicated than that. Now I'm telling you that if this is true, then and I'm sorry by going back to using some algebra or calculus, but all this means is the change in assets have to equal the change in liabilities plus the change in equity. What that means is if we're talking about a statement of cash flows, then the 3 of these combined have to equal what our change in cash was. Cash is an asset. So if I'm calculating what my change in cash was, it should be equal to what the change in the rest of the assets were, putting it equal to what my change in liabilities and my change in equity is. So when we're going through these problems, if you're not tying out to your change in cash, It's because not all of your change in the assets, liabilities, and equity has been accounted for. And so we will have two different methods of putting in the operating activities. People lean towards the indirect. That's just how it is, because it's a lot simpler when you think about it with the way our accounting procedures are set up. We're already in the accrual method, and so it's easier for us to start with our net income and back into what our operating activities were from a cash basis. Direct is going to be straight to the point. What was the cash coming in from customers minus what was the cash going out to vendors? Okay, so we're going to spend more time on the indirect because according to GAAP, even if you use the direct, you're going to have to make a statement about how you go back to the indirect, because in the indirect, we start with net income. Net income is on the statement of net income. So investors can tie that portion out. And then as you go through here, the change in current assets, and I tried to color code this. So these blue assets here, these blue liabilities here, the current assets and liabilities, that change is going to be represented as an operating. Okay, and think about it. So we start with net income that says, here's in net income, you can see that sales is your first line, but the cash wasn't all that was collected for our sales. We might have collected some sales from prior period. We might not have collected this period, so it's still in our accounts receivable. We might have paid out cash to increase our inventory, those type of things. So when we start with net income, we have to account for these changes, which will get us back to a cash-based operating activity. Okay. The long-term assets, that's going to be part of your investing. Now the depreciation part of it will be, the depreciation is going to be in the indirect because it's in the net income, but depreciation isn't a cash expense, so we're going to back that back out. The rest of it will be part of the investing. And then if we made payments on our debt, or if we increased our equity, or if we even paid it back, those are financing activities. So we should be able to tie that back out to the change in our financing. Okay, so I was hoping this graph would kind of help give you that picture as we walk through these assignments today. So going into homework assignment number 8, we start out, so here's that balance sheet, here's our income statement. They give us some few information, and they want us to present the cash flows using the direct method. Okay, so here we have to calculate directly what was the cash received from the customers. All right, and so we know we had 672,000 in sales. And we also have, but we received that much in the change in accounts receivable. Okay, so because the AR went up, that means that we did not collect, so that's going to be a reduction of the sales. So we have this much in sales, but we increased our AR, which means we collected less cash. So that's a reduction of that to get to the cash received. All right, then we had to pay for our inventory. So we start with the cost of goods sold. And same thing with our inventory here. So we increased our inventory. So not only did we spend this much on our cost of goods sold, but we actually increased our inventory. So that's going to increase how much we paid out. But our AP as well comes into play. So we decreased our accounts payable, so we paid more into that period. Like I said, as you're going through this, you can just make sure, you have to make sure that you go through each of these accounts, and that's going to increase 406,390, 406,390. Then other expenses, 150, and then you're changing the prepaid right here. And since prepaid went down, that means we paid more into it. Or we used less, sorry, it's a subtraction. Because when the 150 that was expensed, part of it was already paid for last period. 149. And then income taxes, it's just income tax expense. There's no change in an income tax liability account. So it's just that amount. Okay, and as I said, to double check for operating activities, we've dealt with everything here now, and we have one short term on the notes payable though, so that's not going to come into play into our finance. You can see that's all of our operating activities at this point, and we've included everything up into net income, except for depreciation, which is a non-cash expense, and the loss on sale, which is going to be a financing or investing activity. So we go into our investing activities. So we have cash received from sales. That number had to be given to us. So we had that much in cash that came in the door. So that's a positive investing activity because we're getting rid of an investment asset and exchanging it for cash. But we're turning around, we also paid for equipment. We're investing in a future asset by paying out cash. And you can see that that would be equal to the change in equipment less the depreciation. And at the same time, it would be equal to our notes payable on the financing activity. So all of our financing, they tell you that we borrowed on a short-term note. You can see that that short-term went up. That's an increase in our cash flow or borrowing. We paid down on long-term debt. That's in your notes. We issued stock. And then we paid out dividends. All right. All of that together, you have your operating, you have your investing, you have your financing, the net increase or decrease in cash, and that should balance back out with your cash, change in cash. Okay. All right. So that's pretty much what these 9 problems are going to make you do. The difference is on the indirect method, we start out with net income. And because we start out with net income, if you go back to the other one, we've already in net income, we include sales, but we don't take into the account the change in AR. So we're going to put that there. In net income, there's a depreciation expense. Depreciation is non-cash, so we have to add that back. And there's a gain or loss on equipment in here. However, that gain or loss is actually part of an investing activity, so we need to add it back into net income. Okay, so that's what the difference between the indirect and the direct. You're going to get to the same answer, but investors like to see you start with net income because we just turned the page on what our net income was. But we're going to have to do our change in assets, our current assets and liabilities, because again, this included sales, didn't include cash from customers. This included cost of goods sold. It didn't include your change in inventory and your change in AP. Okay, so when you start with net income, you then do the net increase or decrease in cash. Add back your non-cash expenses or your items that go in other places. And then the investing and the financing are going to be the same. So as you go through these, you should be making flashcards of each one of these items. Does it on the other side of your flashcard? It's an investing activity, it's an operating activity, or it's a financing activity. Anything dealing with long-term assets, that's going to go into investing. Anything dealing with long-term liability or equity is going to go into financing. At the end of the day, our change in cash has to equal our change in cash. And again, they're making you these flashcards for you. So when we have sale of property, that's investing. Cash from sale of equipment, investing because of the equipment. Debt. Interest here is the key word. Our interest is going to be part of our operating activities because that's the interest that was used to operate this month's activities. Okay, that's a current expense. When we talk about debt, that's financing. Debt, that's financing. Dividends from investments. So the investments is considered a short-term investment here, and those dividends is when we're the owners. They're making the amount that we invested to them is being returned to us in the form of a dividend. The reason we're getting that dividend is because of operations that were current in that business we own. Utilities is operating. Rents, that is a current operating expense. Bird stock is equity. Equity is going to be financing. And a building, if we're buying a building, that's going to be investing. So here they want you to use the direct method. So it's going through those same calculations. For the customers, it's going to be our sales plus or minus any change in receivables. Payment to suppliers is going to be your cost of goods sold plus or minus your change in inventory plus or minus your change in current payables. Salaries is going to be a salaries expense, change in salaries payable. You're just matching those up. Same thing, you're matching up the income statement account with the change in the asset account. Going through each of those, and they only talk about operating activities here. So it's just matching up what the income statement account is to what current asset account it impacts. And the thought is you're getting it back to, so this income statement is based off the accrual method, and you're getting it back to a cash-based approach. This is how much sales we had, But if accounts receivables decrease, that means we receive cash more than what was borrowed out. So that's going to be an increase. Okay. Inventory, this is how much on an accrual basis our expense was, but we were able to increase inventory, which means we paid an additional amount for our inventory, and we decreased accounts payable, which means we had to pay out more than what we received this period. Okay. Here we're going to go with the indirect. So we're starting with our income statement account. Because we start with the income statement, some of these items are non-cash. Depreciation is a non-cash expense. The depreciation, the cash flow, was an investing activity on the day that we bought that asset. So we're going to add that back. Our AR here has decreased, which means that the sales that's included in this figure did not include, we did not receive cash on some of that. Or decrease, sorry, a decrease that's positive. So we received more cash than what sales were for that period. Salaries payable, that's a liability. So we incurred the expense of the salaries, but we didn't have to send that cash out the door yet. So we're going to add it back to our salaries expense. The accrued liabilities decreased. So that means we had to pay an additional amount of our other expenses. So that's going to be a decrease since we already have the other expense included in the net income, but now we're showing that we also paid to reduce that liability. And that gets you to your operating activities. All right, here, same thing, they want you to do the indirect method. So the cash received from the sale of equipment. So here, our book value was $53,000, and we sold at a loss of $5,600. So if it's on our books for this amount, and we had a loss of this amount, then that means this is how much we received in cash. How much depreciation expense was recorded? So you're going to try to get back to depreciation. So for the equipment, so we know that the accumulated depreciation decreased by 236 from 236. All right, so with everything, it's going to be beginning plus additions minus subtractions equals ending. Okay, so our beginning was 236. Our ending is 126. We're trying to find out what the depreciation expense was. And we know that this equipment had 275,000 with a book value of 53. So that means that we had recorded a total of 222,000, which means so our depreciation expense would have had to be 112,000. Okay. Because again, we disposed of 222,000. So we started with 236. We disposed of 222 when we sold that equipment. Our ending is 126. So the only number that gets you there is 112. What was the cost of the new equipment purchased? Okay, so same thing. We started with 245,000. Ended with 245,000. We started with 335. We Had original cost of $275,000 that was disposed of. So if we disposed of 275, we started with 335, and somehow we ended with 245. That means we must have purchased something for 185. And you're just going through the T accounts here. I put it just in a different way, just so you familiar yourself with this formula, because this is a roll forward. Every account, start with your beginning, add something, subtract something, you get your ending. Here we're talking about equipment, so the additions is any purchases, accumulated depreciation on equipment. The addition is your depreciation expense. Subtractions are going to be disposals. Beginning and ending is what you're referring to. On the indirect method, we're going through the same thing. Cash receipt from sales, at a building of a book value of 83. So we're just going through the same T accounts here, making sure you're showing building as an asset, so the debits are increasing, credits is your disposals, accumulated depreciation is a contra asset, so knowing what side the credit starts. When we dispose of it, it's a debit. When we do the depreciation expense, we credit that account. Just going through the indirects, we start with our net income, again, non-cash items, changing our current assets, current liabilities, get you to your operating. Indirect again, net income, add back your non-cash, add back your change in balance, get you to your operating. Alrighty, and I wish y'all the best on the final, and please reach out with any questions. I did send out the announcement that explains which chapters you need to go over. It's 25 questions. It is multiple choice and true or false. You're allowed any notes or anything while the test is going on. I will be in the Zoom meeting at 4 p.m. on Wednesday if you would like any last minute questions. I wish you all the best and have a good week.